Hi, folks. Welcome to the Weekend Investing Daily Bite of Tuesday, 29 July. And please go through the disclaimer. Please read it and fully understand this and then go forward. Today, we're going to talk about one metric that can really fool you when you are looking for investments and get fooled by the past returns of an investment. That is always possible. So, I'll tell you what metric that is and how you should evaluate any investment. So let's say you have picked up and invested in a strategy with 5 year CAGR of whatever 20, 30%, 40%, and not paid attention to anything else. Then there could be a situation where you are buying something that has not done well. Uh, so the questions that you may want to ask is, was the 20% CAGR due to a favorable starting point? Because CAGR, as you very well know, is a cumulative aggregate growth rate, and that is dependent upon where the starting point is. So the cumulative annual part of the CAGR almost means as if 20% was getting delivered, but it is the cumulative growth rate, and hence it is some sort of an average over that period of time. How consistent was the performance across those 5 years? Obviously, in stock market terms, every year cannot be the same as the previous year. There will be ups and downs, and over a long period of time, will you be really be able to see what is the consistent period returns of that strategy? And was there any extended phase of lull during the course of those 5 years? So these deeper aspects are missed by the CAGR question because it is a long-term average. Now let's see, for instance, uh, returns from COVID bottom or near bottom versus pre-COVID, so as to say. So if the starting point was pre-COVID, then the returns would be different. And if the starting point was just after COVID, the 5 year returns would be different. The CAGR for both, which are just 3 months apart, the starting points. So the start point can make a huge difference. So here, for instance, 5 year CAGR from two different start points. First was January 2020 to January 2025. 5 year CAGR of 14%, and then perhaps from May 2020 to May 2025, 5 year CAGR is 20%. So not much difference in terms of uh, uh, the start point, but a huge difference in the outcome. Of course, the main difference being because of these 2 3 months, and depending upon whether you were going to bring in a lump sum investment here or a lump sum investment there. If you are going to bring your money gradually over this period of time, then either of them doesn't really make much of a difference. Another huge problem with the point to point CAGR is that in our minds, because our minds are sort of linearly programmed, so our brain draws a linear projection and says every year it is 20, 20, 20, 20, 20. And any deviation for a small period of time, people are willing to give up that journey and say that, oh, this year or last 2 years I didn't get 20, this strategy is failing. So this is where most of the investors actually fail in terms of sticking on to a good strategy, and they keep hopping from one strategy to the other basis the last 1 year results. A lot of funds also face this issue, that every year, of course, there will be some five funds out of the 200 or five small cases out of the 500 which are going to be the best that year, and it is not going to stay the same every year. So every year, if you decide to be in the best, the next year perhaps they may be they may be in the middle, they may be at the bottom, and the next year again you will go for the best, and the next year post that again you will be disappointed. So this hopping business needs to stop, and that requires you to study the strategy, the returns over more than just the CAGR also. So making decisions solely based on plain vanilla point-to-point returns may not be the best way for you. So what is the solution? The solution is rolling returns. So rolling returns is basically uh, calculating a period return for the same period multiple times. So let's say if we have a 5 year period and we want to take 3 year rolling return. So first day, what from first day till 3 years, what are the returns? Then from second day till end of 3 years from there, what are the returns? Then from third day. So you have multiple data points across that 5 year journey with 3 year returns plotted out. Okay, so let's take an example, May 20 to May 2025 period, and see where the rolling returns is. So this is 1 year rolling return, the black line. So from each month, it is basically calculating the 1 year performance. So the current 2025 period is basically May 24 to May 25. Here, May 21 was 62% higher than May 20. So this black line is the 1 year period. Now the orange line is the continuous CAGR. So it will mimic the first year, of course, and then gradually it is now the average of all these years, and it's a continuous CAGR. So you may basically look at the strategy and say that 20% CAGR is great, let me buy this strategy. But in your mind, you are not ready to spend perhaps a year and a half, 2 years here with zero returns, perhaps a 1 year from Feb 24 to Feb 25 of zero returns. And when these periods will come, you will say, I'm not getting 20%, so why should I stay on with this strategy? So the key insight here is that the 1 year return was greater than the CAGR, the continuous CAGR, for only 4 out of 60 months in the period. So only four such periods came where you said, wow, I'm beating the expectation that I had. But actually speaking, uh, for most part of the period, you were not being satisfied with the result because you had in your mind that every year I should get 20. So let's also see what was the delta of this 1 year rolling return over the prevailing CAGR for the same time period. So here is the chart, the same chart, basically the difference between the two. And you can see that there are periods where the 1 year rolling return goes to minus 31% versus where the CAGR is. And that will be a big disappointment when you see it in isolation. Otherwise, when I mean at the end of 5 years, you are getting what you're getting at the end of 5 years, so it is not wrong at the end of 5 years. But during this period, there is going to be huge disenchantment with your strategy because uh, in the mind it is set that I should get 20% every year. So let's also take more examples of the Nifty 50 in the last 25 years. And let's see the continuous CAGR at any point and the various periods of 3 year, 5 year, and 7 year rolling CAGR to draw a comparison. So we know the Nifty chart for 25 years. It is a beautiful chart. And just look at this chart. I mean, there was almost a 7 to 8 year period here where Nifty didn't go anywhere, a huge bull run, 2008 GFC crash, market restarts again, COVID crash, market restarts again, and that's about it. I mean, there are three phases of real disruption that happened. First is the sideways phase, where also there was a dot-com boom in the middle. So if you were able to encash that, this decade was not so bad. The GFC came after a mind-boggling move from 1,000 to 6,000. So if you were smart enough to capture, this move and give up some of that, you still were way better off in 5 years from where you were in 2003. And then post that, only the COVID crisis came, which was eliminated in just 4 months of time. So actually speaking, if you were to take a step back and see the Nifty chart, I mean, Nifty has been minting money for everybody like nobody's business. 12.4% is not bad when you compare it with what you're getting in the bank or what 90% investors are doing it themselves. So let's look at a 3 year rolling CAGR versus the continuous CAGR for 25-year period. So here the the continuous CAGR is rising from July 2000. So 3 years, July 2000 to July 2003 was negative 3.8. And then it kept getting better till we hit 2008 because 2005, 2008 was the really good. So the continuous CAGR kept increasing. And then, of course, over a long period of time, as more and more data points come, the average tends to become very, very smooth. So here, you are at 12.9, 12, 13, 12.5, and so on and so forth. It's difficult to break this average up or down now because there are so many data points here. The 3 year rolling CAGR is bobbing around here and there. So you can see 3 years rolling return went to almost 55%, and then crashed to -3, and then -2, and minus several times negative performance also within 3 year rolling CAGR. So 52% of the times 3 year return was higher than CAGR. But if you ignore the GFC part, this part right here, then that percentage drops to 39%. So only 39% of the time was where 3 year returns was better off than the CAGR. So you could basically say that depending upon where you came into the markets, uh, even though a cumulative CAGR here was 15%, if you came into the market in 2008, the next 3 years return was zero. So you may have expected when you entered in 2008 a return of 15%, but the next 3 years was zero. So this is also how the CAGR can be misleading. Again, we will see as the time frame of rolling returns goes up, this gap will tend to reduce. So let's also look at 5 year rolling returns. So 5 year rolling returns, the same thing. You can see that the 5 year rolling return chart has smoothened out. The volatility has reduced. Here we had gone to more than 60%. Here we are barely at zero twice, and it is tending to go towards the continuous CAGR. So here the surprise from holding on to your position for 5 years is not going to be as much, although there could be. So for instance, if you were, let's say, right here in '09, and you said rolling 5 year rolling CAGR is 14, sorry, the long term rolling CAGR is 14%, but in 2014 you actually got 16% or so. So despite the 5 year rolling CAGR going to zero during that period. So as you increase the rolling returns period, it tends to go towards the accumulated rally. And here you can see 47% of the time the 5 year returns was more than CAGR, and if we remove this portion, the GFC portion, the percentage drops to 38%. So 62% of the time the 5 year rolling returns was poorer than the CAGR. When we go to 7 year CAGR, you can see that it is almost compressing and aligning with the long term CAGR. Here, you can see that in the last almost 7 years, virtually it is hugging the long term CAGR line. And again, if you remove this portion, you will find that 37% of the time, 7 year rolling returns were more than the CAGR. So the key takeaways here are that more than 95% of investors are making decisions based on uh, the past performance, the CAGR across 1, 3, 5 years. Strategies may not replicate the past CAGRs in a linear fashion. Past period CAGR should only be one of the factors that when you see to consider a strategy. You also need to see what is the philosophy of the strategy, what is the style of the strategy, what is the historical volatility, what are the drawdowns, is there a starting point advantage to those periods, is there a risk reward ratio, the ROMAD ratio, where does that stand, what are the different rolling returns, what is your likely period of investment in that strategy versus the same period rolling returns, and you can take an average of the rolling returns. So here where we are, you can basically take an average of, let's say, the last 10 years of rolling returns, and you will find that the average perhaps will come very close to the long term CAGR also in this case. But in all cases that may not be the case. And what is the performance relative to the benchmark also. So these are some of the key takeaways for such a comparison. So if you like this video, you may also like this other video that we did recently on the global diversification. What factors do you consider before choosing a particular strategy?